Here's a quick video just running through the different types of insurance options that are available and a little bit about what they cover and how they can be structured. We'll recap them and go through them in a bit more detail when we catch up. However, this is a bit of an overview to give you a bit of an idea and get you thinking a little bit more about the types of cover, what sort of things you do and don't want protected and insured against. And then from there, we can go away and do some research into the market and see how much these types of things will cost, how we can structure it through super and outside super, and make sure we come up with the right and ideal solution for you. So before we go through the actual personal insurances, there's a few different types of insurances. These days, you can insure for pretty much everything. And the idea is not to go overboard, but at the same time, lay the foundations for the financial house and financial building that we're creating and your financial life. So it is very much like building a house. You spend some time building the foundations, and some of that is things like the cash reserve that is being put together. The insurances form a part of that, making sure you have solid foundations that if something does go wrong, you've got the ability to fall back on those protection and risk management mechanisms. So the other types of insurances, which we won't touch on in this one but can look at separately, are things like home and contents, car insurances, private health, pet insurance, and those type of things. So they're all important to have, and it's about making sure that you've got the right level of protection for what you want and what you need if something goes wrong. So it's not necessarily having everything and the best of everything. So private health, for example, some people choose to have it, some people don't. Some people choose to have top level cover, some people choose just to have basic. Same with the personal insurances. Some people choose to have everything. Some people choose just to have a certain amount. Some people want the most comprehensive. Some people want just the standard, good, value for money type of option. So it's really about working that out, fitting within budgets, and making sure that you've got what you need in place when you need it. So even personally, from where we are, we have essentially a bit of everything in terms of all the personal insurances, a bit of private health, obviously home and contents, car insurance, even pet insurance for our dog. We structure it in a way that some's through super with the life and insurances, some's tax deductible with the income protection, and the other ones are budget friendly, I guess, if we want to call it that. So it's value for money, that we've got what we want. We don't have the bells and whistles a lot of the time, but we've got the cover that we need and have claimed on quite a lot of it, actually, especially over the last few years. So it has come in very handy and been quite valuable. So this video will go through more the personal insurance aspect, not so much those other areas, which we can look at separately, and make sure that overall you've got a really sound risk management strategy in place. So there are four main types of personal insurances: life cover, total and permanent disability, trauma, or sometimes known as critical illness, and income protection. The life cover and total and permanent disability, or TPD, both provide lump sum payments. Life cover is paid out upon death if you pass away, or if you're diagnosed with a terminal illness. So for most insurers, that's if a doctor and a specialist say that you've got less than 2 years to live. Some are 1 year, but most are 2 years to live. And this covers things like your mortgage and any other debts, make sure that's paid out so the family is taken care of financially. Any future education costs for the kids, so they're not disadvantaged, and usually a bit of a cash buffer to make sure that if something serious in this type of instance happens, the family have something left over from a financial perspective to take care of themselves. The permanent disability covers similar things. So the difference here is this will protect you and pay you out if you're unlikely to ever work again. And there's a couple of ways that this can be structured, whether it's looking at any type of job that you've had sort of experience in, or whether it's your own job that you're doing now, whether you can't work in that again. And they're the things that we'll go through. But the idea is this will pay out if you're unlikely to ever work again. So it's quite serious injuries or illnesses, major spine injuries, or things like motor neuron disease, even multiple sclerosis. It covers similar things to the life cover, we make sure that your mortgage is paid out and other debts, again, any education costs that want to be taken care of, as well as that cash buffer. The big difference here is we like to include an amount for medical and rehab costs. So we don't know exactly how much that will be, but we have an estimated amount based on research to provide things like revamping the house, wheelchair access, getting a new car if needed, physio costs, rehab costs, occupational therapy if required. So there's a lot more involved with this one for the amount of cover required. When I say the things that it covers and pays out for, when you receive money in a claim, you don't need to allocate it to those areas, but we like to, as part of our analysis, factor all of that in to work out the amount that you will need to live comfortably or for your families to live comfortably if something happens. So in the life cover instance, for example, say overall, in terms of paying off a mortgage, some other debts, having a cash buffer and that type of thing, there's $1 million worth of cover needed. If and when a claim's made, that $1 million gets paid out. It doesn't need to be paid into these different areas, but you've got that $1 million, your family has that $1 million to use, and we've calculated that using an analysis of this. So the trauma and critical illness also is a lump sum amount, usually a bit lower, quite a bit lower than the life and permanent disability. We don't necessarily look at paying off a mortgage. This one is to cover more medical and rehab costs, but especially medical costs involved with serious or critical illnesses. So this is things like cancers, strokes, heart attacks, brain disorders, ICU type of events. So very serious things, not necessarily that you're going to pass away from or can't ever work again, but something where you're going to need time off work. Your partner might need time off work as well. So the idea is making sure that you have some money available to cover those type of things. The final one is a bit of a catch-all in a term in terms of income protection. So this is essentially to replace your monthly income if you can't work due to injury or illness. So the idea of this one is that it covers a portion of your regular income because there's still going to be your bills to pay, mortgage repayments, etc. if you're off work. So this will cover you whether it's a short-term or a longer-term type of injury or illness. It can work in line with things like permanent disability. So if you are permanently disabled and you have this, you may and usually do also get a monthly income protection claim. But this one can be, for example, you've hurt your back, you need 6 months off work, and you're going to be able to go back then. This will cover your portion of your income for that 6 months, so you can continue on as per normal, get better, and then you go back to work. The income protection has a range of different payment periods, and this is where there's a lot of levers amongst all of the covers that we can look at to make sure you get the right amount of cover and a good amount for you, but also, especially in current day and age, that's value for money and cost effective. So it's about working in line with the budget, making sure that you're still achieving all your other goals, but setting this foundation in place that if something does go wrong, financially you're taken care of. So this is really to protect you, your family, and the plan, not so much insurance for insurance sake. So in terms of payment periods for income protection, when you make a claim, there's three main options. One is for a payment period of up to 2 years. So if you're off work for 6 months, you'll get paid out, and then the insurance claim will go back to the insurance will start again if you make another claim. It's not cumulative, so it'll reset back and you'll have 2 years available for every claim as long as it's not related. If it's a 5-year type of payment period, same again, it'll just pay out for longer. So in the 2 year, if you're off work for 3 years, you'll get paid for 2, and then that'll cut out and you'll be relying on other areas. Whereas if you've got a 5-year policy or payment policy, if you're off work for 3 years, it'll pay you the full 3-year time frame. The longer term benefit is to sort of retirement age, 60, 65, some even up to 70. So this essentially covers the long term, so no matter how long you're off for. So if you're off for 6 months, 3 years, 10 years, or forever, this will pay you out essentially until you're either able to go back to work or until that age 60, 65, 70, or whatever date we set or age we set. Whereas these ones cut off either after 2 years or 5 years, or when you're able to go back to work. So cost-wise, the to retirement type of option is more expensive, and these ones are lower cost. So again, there's some levers we can work with to see, all right, is it worthwhile at least having something in place? It might be 2 or 5 years of sort of payment period to start with, or at least initially, rather than the ideal full cover, and then working from there. The other thing that can be done, and most likely a lot of people do have this, is having life and permanent disability through super, and this can be owned and paid for from your super fund. The income protection can as well, but we generally like to have that outside super because it is tax deductible personally, and there's generally better options available and better claim ability when it's owned outside of super. Whereas the life and total and permanent disability can be owned and paid for within super. We can link the permanent disability mostly through super and a bit of outside super as well to get the best of both worlds with certain claim ability and occupation definitions. But the majority of that in the life insurance can be paid from through super. There are some tax implications with this, with the total and permanent disability, which we'll go through and can add some extra in for that, or have the payout cover those. The good thing with this is it makes it more cost effective for you. We can also look at adding a little bit extra into super, which is tax deductible, to pay for the insurances. Whereas if we have the insurances outside super, say for example, these combined cost $100 a month. If you pay for that personally, it's $100 a month out of pocket after you've been paid. Whereas if it comes from super, you can contribute $100 a month or a portion of that into super pre-tax or salary sacrifice, for example, and might be able to claim 30 or so percent or 33% of that, depending on your marginal tax rate back. So effectively the insurances are costing a bit less because of that tax benefit. So there are, as I mentioned, ways that we can look at the amounts of cover, the structuring of the cover and the ownership to make them very cost effective and value for money, while at the same time having the right amount of cover for you specifically, both now but then over time, and this gets reviewed to make sure that you've got what you need if and when something does happen.